Hey there, we're up to chapter 21, and this is a chapter that I would probably rank maybe third most important chapter in this text from the standpoint of how many times you will have these issues come up once you start your career. You know, revenue recognition, chapter 8, chapter 13, with current liabilities are important. This chapter 21 on accounting changes. Maybe it's a change in principle, maybe it's a change in estimate, or maybe you have an error that has to be corrected. And we've already looked at changes due to errors in a prior chapter, but we're going to look at it in more detail here and what needs to be done. So it's an important chapter. It's really not that complicated either. So let's go ahead and jump into the PowerPoint, and then we'll get into the homework. See if I can share this screen. Chapter 21. Accounting changes and error analysis. You hate to think you're going to have errors, but believe me, you will. Hopefully they're minor errors. So what's the overview here? We've got changes in accounting principle, changes in accounting estimate, and change in reporting entity. Not going to look much at change in reporting entity here. Probably look at that when you get to advanced accounting. It just has to do with how you do consolidated reporting. But we are going to look at change in principle and change in accounting estimate, and also what do you do with error analysis. We want to be consistent in how we treat changes in accounting principle and change in accounting estimate. You know, that's one of the key things here. There's a couple of terms here that we'll look at, and they're coming up here on the screen here shortly. But let me just go ahead. There's what's called a retrospective approach and a prospective approach. What's retro mean? Most people know what retro means. Is going back, which is exactly what you want to do when you have a change in accounting principle. You want to retroactively go back as far as you can, as the data will allow. Of course, in today's world, you pretty much have the data to do that, the transactions on your databases, to go back and implement this change in accounting principle. You want to go back. Prospective, on the other hand, means what? That's going, well, current period and going forward. That's what we want to do on an accounting estimate. Retro here, perspective here. Change in the current period and going forward. You know, I've talked a lot about changes in depreciation. Maybe got a change in the salvage value. Maybe you decided that this piece of equipment that was being depreciated over 5 years, you're 4 years in, you find out, well, it's really going to last 7 years. And so you just change the depreciation there for 3 more years if you're after year 4. Those are changes in an estimate. If you made a good faith determination or decision at the beginning, then this change in estimate doesn't require that you go back retrospectively or retroactively and change your books from the beginning. You just want to change in the current period and going forward. A change in accounting principle, on the other hand, is retro. You got to go back, and when you're going back, you're changing what? You're changing retained earnings with a prior period adjustment. You don't have change in retained earnings prior period adjustment for changes in accounting estimate. So therein is really the two big differences. And the third part of this chapter we'll look at as we go through here is errors. What do you do with errors? Well, if it's material, right? Materialism, materiality. The materiality principle, if it's material and it's an error, you need to go back and do a retroactive change. If it's not, if it's something very insignificant, then no, you don't. You just change in the current period going forward. I also had the issue there of whether the books are open or the books are closed. The books are still open when you made the error. It's easy. You just make a correcting entry. But the books are closed. That's when you have to ask yourself, is it material or not? Is it significant? We'll get to that. All right, so there's the term consistency, right? Consistency. You want to use the same accounting methods period after period after period. It helps achieve the goal here, comparability, right? Very important. You want comparable statements year over year. There's those two terms I talked about. Retrospective. Restate all prior year financial statements presented in the annual report. Very difficult, because if you're retrospectively going back, all you've got to go on is retained earnings, because remember, your revenues and expenses, temporary accounts, they've been closed, haven't they? And zeroed out, theoretically, to income summary, and then what? Retained earnings. Very difficult to go back and reissue statements. A lot of off financial system preparation has to be done if you can't make these entries to expenses and revenue. And restating those financial statements, a lot of that is offline from your normal financial software that you might be using. Retrospective, assets and liabilities, your balance sheet accounts, your permanent accounts, that's the only thing you can really impact, retained earnings, but you can't do anything about your income statement accounts in your ledger. You have to do that offline. Prospective is when we're going to make it in the year of change and forward. Again, that is for estimate changes. You know, I used the example of depreciation, but what are some others? What about warranty? You already had warranties. What about your inventory? Net realizable value, your allowance account, allowance for bad debts. All of those. If you had a good estimation based on empirical evidence for those allowances, if those percentages are off, if you need to change your warranty from 2% to 3%, which sounds like a big deal, you're not going to go back and make prior period adjustments to retain earnings unless it was an error. Now that's a different story if you have an error on your estimate. But if it's just an estimate that's changed because your business has changed, you're going to do that prospectively going forward. But there's all kinds of things out there that are classified as estimate changes: inventory, warranty, depreciation. Just keep that in mind. Interesting enough, when you talk about this, the one you're probably least likely to change, the one that gets talked about the most in textbooks, is depreciation. I don't think I've ever made a change to depreciation service life or salvage value. Usually salvage value is 0 and you put it out there to be depreciated over a length of time. That's the time and it's over. But the book likes to talk about that. But warranty, on the other hand, inventory, net realizable value, allowance for doubtful accounts, bad debt, things like that, very common to make changes. All right, how about changes in accounting principle? You should only voluntarily change accounting principles if the new principle more accurately portrays its financial position and performance. That's the only justification for changing your accounting principle. It's not to give bigger bonuses. It's not to ensure that these stock options that have been granted get exercised. It has to be based on more accurately portraying your company's financial position. That's the reason you do it. They use a term here called impractical. Is it impractical to go back retroactively? Maybe in the old days when people used 24 columnar pads, but today with the use of software, it's usually determinable. Direct and indirect effects associated with these changes. Kind of skip through that. here's a good exercise that they go through with about 7 or 8 different slides. And I would argue they probably could have done this with just a couple of slides. Let's just read this. It says here that Topeka Towel Company began operations. They're going to switch from FIFO to the average cost method for financial reporting purposes. It did not switch methods for tax purposes, which tells you what? Going back to the income tax chapter, you got a temporary difference, right? Deferred tax asset, deferred tax liability. So they're going from FIFO to average cost. Well, look down here at the bottom of the page, FIFO to average cost. They began operation on January 1, 2011, beginning of 2015. Beginning of 2015. All right, so if we stop right there, draw a line across there, what's the difference in those two columns as far as the change in cost of goods sold? Well, let me just add it up here. I wish they did that on here, but they don't. They may on a later slide, I don't remember. All right, so cost of goods sold, FIFO, is $22,000. Cost of goods sold under average cost $9,000 plus $6,000. I don't know why they don't just round this off to the nearest thousand. 28.6. So what am I doing? I'm going from FIFO to average cost. So by going from FIFO to average cost, my cost of goods sold is going up, isn't it? It's going up by $6,600. So if cost of goods sold is going up, what's going to happen? I don't have room to write on here. Cost of goods sold goes up, what goes down? Inventory goes down. And if my cost of goods sold is going up, then my net income is going what? Down. Cost of goods sold goes up, inventory goes down, net income goes down. Cost of goods sold up, inventory has to go down. If inventory goes down, your net income's going down. All right, so keep that in mind, 6,600. All right, we're going to skip all of those. Maybe they do add all that up there at some point, but I don't see it. All right, so we're to this page. Difference of 3960. So right there's my 6,600. We just calculated, right? 6,600. So I got $6,600 more in net income. Excuse me. Cost of goods sold up, less net income. Cost of goods sold went up, net income has to go down. So 6,600 times 60%, because the tax rate is 40%, right? That was in there somewhere. 40% tax rate. So again, we're using the 1 minus the tax rate to see what the impact is on retained earnings. So instead of, since the books are closed, obviously, this is for the last 5 years, then 3960, 60% of 6,600, 3960 is what? The reduction of my net income. Cost of goods sold went up, $6,600, so $6,600 is coming out of my net income, net of tax. I'm reducing retained earnings by 3960. There's my inventory, right? Because what did I say there with inventory and cost of goods sold? The information given was cost of goods sold. So if cost of goods sold went up, right? Cost of goods sold went up to $6,600, wrong side, 6,600. If that went up, then what happens? This has to be what? Reduction of inventory. Whatever is there is going to impact inventory. It's my income statement. It's my balance sheet. It's coming out. It's coming off my income statement, going back on my books as inventory. Cost of goods sold, excuse me, I misstated. Cost of goods sold, it's come off my balance sheet, it's gone to my income statement. So I'm reducing my balance sheet by that amount of inventory. It's coming off my balance sheet and going to my income statement. There's the 6,600 inventory. There's my 3,960, and there it is. You thought you were done with that in a prior chapter. Deferred tax asset. Has to be. It's got to have a debit balance. You don't start off with a deferred tax liability, do you? So you've increased your cost of goods sold because it said that you're keeping the same method under your tax system. So you're going to have to what? Pay more tax now, in essence, and get it back later. That's a good exercise to get you into this, to see what happens when you have a change in accounting principle, because changing from one costing method in accounting to another costing method, that is a change in principle. All right, so that's the one we'll look at. We'll look at some more exercises here in Pearson on the next video. I had some excellent exercises to use, but I won't be able to test on those, so I'm not even going to bother sending those out this semester. All right, so let's look at, and that's spring semester 2020. Might be different for a future semester. Explain and illustrate the accounting for a change in accounting estimate. Again, what are we going to do here? Big picture, we're going to adjust the current period where the books are still open and future periods. Not going back like we just did with retained earnings, right? Deferred tax assets. Current period and future periods. They use several examples there. Bad debt, depreciation, inventory, pensions. That's a good one. We just covered that, didn't we? A couple chapters ago. And so we're going to use for accounting estimates up here, we're going to use the prospective method. Current period when the books are open forward. So they acquired a plant asset for $1,000, depreciated equipment using straight line for 10 years, no scrap value. After using the asset for 6 years, they believe that it will be productive for another 8 years. So 6 years in, then they're going to do it for 8 more years, opposed to 4. So how are they going to make this change? Well, they had $100 per year, so the book value is $400, right? You always have to ask yourself, well, where am I? You got to know what your book balance is before you can make adjustment going forward. So my book value is $400. And if it's $400, then I've got another 8 years, 400 divided by 8, then that's going to be what, $50 per year going forward. So you always have to ask yourself, where am I? Of course, you just look at your trial balance, but in these exercises they show you here, that's not necessarily the case. We'll skip through those. You can read those on your own, and then we'll look at the exercises for those as well. Change in reporting entity. We're going to skip through, because we'll leave that to the whole consolidated reporting, consolidated statements. You see down here at the bottom. The change in accounting principle, change in accounting estimate, and change in what? Reporting entity. Do that in advanced accounting. But this is a good little cheat sheet here that tells you what to do as far as the accounting treatment. See that? Retrospective, prospective. Disclosures for that. They give you some examples there. All right, so that brings us to the final part of this chapter, 3 parts. Change in accounting principle, change in accounting estimates, and now we're going to look at error analysis. And this is where you will spend quite a bit of time in the future in your career, believe it or not. So what is an error? Well, it's unintentional. It's not fraud. Fraud is what? Intentional misrepresentation. Firms account for error corrections with the retrospective method and classify all changes affecting retained earnings as prior period adjustments, the old PPA. Retained earnings, you've already been exposed to that somewhat. Retained earnings, prior period adjustment, that's one account title. Unless it's immaterial. If it's immaterial, you don't have to worry about it. And sometimes errors self-correct themselves. And what's he talking about? Well, let's look at this. Here we've got balance sheet errors. What if you have, and this is unusual, normally it's both income statement and balance sheet in one. We'll get to that. What if it's just a balance sheet error? It only affects the asset, liability, or equity. You just make an entry for that. Retained earnings is not involved. Typically for something like this, they give the example there. What if it's a long-term note receivable that's short-term? And there's where $425,000 incorrectly recorded this. Not debiting cash, but crediting accounts payable and note due in 5 years. So that $450,000 is a long-term liability. Take it out of accounts payable and put it into notes payable. So you've just taken it out of one liability account and put it into another. Very simple example there. What about an income statement error? Again, these are not as common as well compared to the both balance sheet and income statement, which we're getting to. But if you've got an income statement error, what if you have a gain on the sale of an asset? What if you booked it as revenue? Would be a good example. So you just take it out of one income statement account, put it into another income statement account. And there's the example they're giving you there. They booked a gain on sale of equipment as sales revenue. So they're taking it out of sales revenue and putting it into the gain on sale of equipment. So that's a purely income statement error that has to be corrected. Of course, that one is what? That one is assuming that the books are still open. They don't state that, but it's assuming the books are still open for the current year, current period. All right, so here's the more common one, is what happens when you have an error that affects both. And they do a good job here of stating, what about CapEx versus expense? Happens all the time. What if you spent $12,000 on some type of equipment repair that extended the life of the equipment or changed its function? That $12,000, what if it was expensed and it should have been capitalized? All right, there's an example where you're affecting maintenance and repair expense and you're impacting property, plant, and equipment. One income statement, one balance sheet. And that's where you have to correct that. That is not what's called a self-correcting error. That's never going to be found unless somebody finds it. What about a self-correcting error? Perfect example of self-correcting error is something like a physical inventory. You got a perpetual system that is keeping track of your inventory, and once a month or once a year you do a physical inventory. Well, what if you miscount on that physical inventory and you book what you think is a gain or a loss? All right, well, that's an error, but if you do another physical count a week later or a month later and you count correctly that time, it's going to correct the prior error that you had, right? So everything's good. That happens all the time with inventory. So you can have some that are self-correcting. CapEx versus expense is not self-correcting. Under accruals. What about an under accrual? Yes, that could be self-correcting. Let me give you an example there that could occur when you're doing accruals, because this is something you might very well run into. There's my smart board. Let's say you're doing accruals at the end of every month. You got 2 days to get those entries in, like, I don't know, April 1 and April 2 to get your entries in for March 31st. Let's say you're making an accrual for electricity expense. Well, let's say your electricity expense is $400,000 a month. They read your meters on the end of the month, the last day of the month. You don't get the bill until maybe the 5th day of the month. Well, you can't wait on the bill to make your accrual. And I'm going to just round this off. But let's just say that you should make an accrual for $400,000, right? This is what you should be doing. And electric payable or utility accrual, that might be a better term, 400,000. But what happens if, in your haste, you make a journal entry for $40,000? Did you start working on your resume and put feelers out for a new job? Because if you put this accrual in and post it, what have you done? You've understated your accrual by how much? $360,000. All right, it's an accrual. Most of the time when you put accruals in like this, you're going to put them in with a designation of being an R. What's an R? That's a reversing entry. So if this entry is going in on 3/31 of 2020, any good software is going to reverse this entry for you the first day of the next month. Which is what? 4/1 of 20. Electric expense. All right, and so that's the end of that month. You're into the new month, which is April. That's reversed. Then you get the bill on the 5th, and you put that bill in. Let's just say, just to make it simple, that goes to accounts payable, and they're going to pay, let's just say it's exactly 400,000. Now these change, and that's not a problem as long as it's not material, right? As long as it's within reason. And this is accounts payable, meaning we've got to pay that bill. This is on 4/5 of 20. All right, we get to the end of the month, and we do another accrual. Electric expense on 4/30 for 400,000. Again, I'm trying to make this straightforward as possible. Electric payable or electric accrual, and that's the end of the month. Well, what's happened here? All right. Up here, you would typically have what? $400,000 impact for the month. If your bills are the same and you're doing the accrual every month. I didn't put those other transactions in up there, but that's what it would have been for a typical month. But because we only did an accrual for 40, then what's happened? I've got expense of $40,000 for the month of March. All right, if you can just imagine up here at the top, what would have happened at the end of February and what happened on the 1st of February, because you only accrued 40, you've got a $40,000 electric expense for the month of March. What about April? What does April look like? Well, there's electric expense, 400, that's 800 minus 40. I've got $760,000 hitting electric expense for April. Oh my gosh, that's terrible. But what happened in this? Over 2 months, what's my total? 800,000. All right, that's okay. 2 months, 800,000. But I had an error here, didn't I? That was an error. But it's self-corrected. It's self-corrected because these entries reverse. This 400,000 here is going to reverse on 5/1 of 20. But my point is, there are such things as self-correcting entries. And these that are accruals are self-correcting. Because you're making a journal entry here in anticipation of an invoice that's going to come in. Well, when you process the invoice, like right here, hopefully you do a good job in accounts payable that you're paying the right amount, and you do, because there's a lot of controls there. But this is a perfect example of what the book is talking about here with a self-correcting entry. Self-correcting. It says 2 years. It can be 2 months as well. If it's over 2 years, then you got an issue there of going back and changing your statements. In this particular case, month over month, no big deal. Unless that was December where you under accrued and then it got corrected in January, then you got an issue there. It's self-corrected, but it's across 2 years. So you would have to make a a journal entry going back to retain earnings, right? Retain earnings and also your payables. They do a better job. 2 accounting periods, no matter what that is. Self-correcting. That was what I just went through. Self-correcting. And real key there. Have the books been closed? They've not been closed like that March and April example I gave you back here. Well, that's over on my notepad, wasn't it? March and April, 2 accounting periods. But if that was the end of the fiscal year, that'd be a big problem. Good point there on inventory versus cost of goods sold. Inventory errors are self-correcting. If you're doing a physical count, yes, they are self-correcting from one inventory to the next. Give you another example there. Next time, we had a physical inventory. We typically did that once a year. I remember one year, it was a terrible year. Just a lot of people losing their jobs at the staff level, and some people had sort of given up, and that made the physical inventory very difficult that year because we just weren't prepared for it, even though I was in charge of it. And they looked at me for the making sure you had a good inventory. Well, when it's all said and done after the physical inventory, we had a $470,000 loss. And on $20 million, well, that's, what is that, 500,000 on 20 million? Was it 2.5%? Still, that's too much. That sounds, 2.5%. But I didn't think we had a good physical count. And so since I was in charge of it, told the plant manager, and I think I've talked about this in class. So the plant manager, I think we need to count again because I don't think we had a good count. Well, the $470,000 loss, I went ahead and booked it. All right, I booked it. So in anticipation that hopefully the next week we would what? We would have a $470,000 gain. That's what I was hoping for, to self-correct what we just counted. Well, unfortunately, we count again next week, and the good and the bad of that is, the good part of that is, we actually had a loss of $2,000. So $2,000 versus $470,000. Also, we had a good count the first time. We didn't need to do the second count. But physical inventories that take place that are meant to verify your perpetual inventory are very important, and they will self-correct. Good slide there when you start talking about inventory and cost of goods sold, right? You remember this from 2020 and probably 3110. Beginning inventory plus purchases, goods available, ending inventory. What if you understate ending inventory? Then what happens? Cost of goods sold is overstated. One's up, the other one's down. Well, it's like playing whack-a-mole at Chuck E. Cheese, right? You beat one down, no one pops up. That's the same way with ending inventory and cost of goods sold. And so if cost of goods sold is overstated, obviously that's expense, cost of goods sold expense, then your net income is going to be understated and your retained earnings is understated. But look what happens in year 2. If ending inventory is understated, right? Beginning inventory is understated, purchases are correct, what's going to happen? Over 2 years, it's going to be self-correcting. Self-correcting inventory error. Very real world stuff here. And so they give you an exercise here that Faison Associates incorrectly recorded inventory in 2014. Rather than recording inventory as 250, they entered 280, overstating ending inventory by 30,000. An inventory summary for 2014 and 2015, that's assuming 2015 was accurate. So what happens there? Like over 2 years, you have cost of goods sold of $250,000. All right, there's my 250, right? as reported. What's the correct amount? 150 and 100. So it's 250 both ways because it self-corrects. That's just the nature of doing a physical inventory. Now, this example, they probably don't have a perpetual system. We're not talking about it. But it's the same. Companies today will have a perpetual system, unless you're just a really small mom and pop. You're going to have a perpetual system. Or Food City. I'm told Food City doesn't have a perpetual system. When you're checking out there and you're scanning your items you're buying, like this Lipton Diet Green Tea Citrus, got a barcode on the side, doesn't it? They just run that through and scan it. I'm told that all that does is it's just a point of sale system that goes out to a database that has all of those barcode numbers, and it's got a price. Probably got the barcode, the number there, it's got a description of it, and it's got the price. It does not track inventory levels like a perpetual system would do in most companies. They do, Food City actually does physical inventories on a regular basis. And then that's where they compare all their purchases with their physical count, and that's what they determine to be cost of goods sold for that term. And that works. And that's similar to what they're talking about here in Pearson. Of course, we have to make prior period adjustments for that, right? That $30,000 right here. Got to go back and correct 2014. How do we do that? Retained earnings 30,000. They're ignoring tax on here, and they're going to increase inventory, aren't they? Or excuse me, decrease inventory. Because what had happened? Ending inventory was what? 250. It was overstated. Ending inventory was overstated. So we have to reduce our inventory. If we reduce inventory, cost of goods sold, right? That's cost of goods sold. But the books are closed, right? Books are closed. So we can't use cost of goods sold. We have to put it into prior period adjustment retained earnings. And there's no tax involved in this, so that's to try to make it as straightforward as possible. So that's my 2015 correcting entry. Look at number 3. It said, if they discover this before closing the books in 2014, before closing the books, it's simple. Put the cost of goods sold. But when the books are closed, you got to go to retained earnings. Cost of goods sold. Still inventory. You got to get your inventory adjusted right because that's a balance sheet account. But you can go against cost of goods sold if the books are open. All right, what about non-self-correcting? You know, like that CapEx versus maintenance. Unless somebody's going through your ledger, like an auditor, and finds it, you're never gonna catch that. It's not self-correcting. Say you're never. It's not likely. Not self-correcting. So here, the Underwood Company acquired a circuit board stamping machine for $700,000, December 31. The journal accountant incorrectly coded the invoice as repair. So they debited repair expense for $700,000 and credited cash or accounts payable, and normally would have been depreciated straight line for 10 years. Error was discovered later on December 31, 2015, before the books were closed. Prepare the journal entry for this. All right, so you're just going to take it out of repair expense and put the machine in because the books are still open. I guess he made the error the same day that he discovered it. All right, what if the books are closed? So here's an example that December 31, 2015, they discovered this error in 2016 after closing the books for 2015. All right, so then we have an issue with going back. So 10 years, no salary, so that's $70,000 a year depreciation expense. But first we have to, because the books are closed, if the books were open, that was what? Maintenance expense. But the books are closed. We can't do that. We got to go against retained earnings. All right, which is going to boost our retained earnings, right? We're taking out a maintenance expense. We're going to put it to property, plant, and equipment, and then depreciate it. And then we need to do the depreciation also, don't we? Well, they skipped that part. Well, let's continue on here. Underwood Computer Company, same information, $700,000. There it is. All right. Maybe I fat fingered it. I don't know. So there's my machinery, $700,000. Depreciation expense for 1 year, right? Accumulated depreciation, what is this, 3 years? What did I miss? Oh, they changed the date. All right, December 31, this is different. December 31, 2013, and then they don't find out about it until when? December 31, 2016. Before closing books for 2016. So we got 2013, 2014, and 2015. So we got 3 years of $70,000 in depreciation. We got to get that $700,000 out of there as well, don't we? And put it to the asset. All right, so that makes sense. So there you have it. There's my machinery. It's coming out of my retained earnings. And my $70,000 depreciation expense, that's got to be what, 3 years worth to get my balance sheet accounts, my permanent accounts correct. And so the difference is going to my retained earnings prior period adjustment. All right, 700 minus 210, 3 years of depreciation. Three years. 70 times 3. All right, so that is chapter 21. Chapter 21. So now we will proceed to the homework for chapter 21. See if we can work our way through that. Have a good day.